Venture capital, we hear about it all the time, fueling the next big thing, the engine behind innovation. But beyond those headlines, how does this high-stakes world of funding actually work? This deep dive, well, it aims to give you a real understanding of venture capital, drawing directly from insights shared by leading practitioners themselves.
That's right. It often gets romanticized, but our sources offer a much more ground-level view, the actual mechanics. We'll be exploring, well, pretty much everything, from what it takes to build a VC career to the often hidden world of the limited partners, the LPs who invest in these funds, and then the investment strategies, the due diligence deep dives, and ultimately how returns actually get generated. For someone like you wanting to grasp this quickly and thoroughly, this material is gold.
Exactly. We're going to unpack what kind of person thrives as a venture capitalist. Who are these limited partners? What really motivates them? How do VCs even decide which companies to back in the first place? That intense scrutiny of due diligence. And then the end game, the exits. Consider this your kind of express route to understanding VC without all the usual complexity. Ready to get started?
Absolutely. Let's kick off with Chapter 3. What's it like building a career as a venture capitalist? One of the first things that jumps out is this fascinating mix. You've got the intellectual stimulation, constantly evaluating new ideas, new tech, alongside, of course, the potential for significant financial rewards.
Okay, so it's definitely more than just chasing those big payouts.
Well, significantly. Our sources, they really highlight that successful VCs tend to share certain aptitudes, certain ways of thinking. Terry Maguire, for instance, emphasizes optimism, a genuine belief that transformative change is possible. Paul Bancroft III points to the vital skill of listening, really listening, stressing that you gain more insights by hearing others than by, talking all the time. And several others, like Bijan Sabeh talking about Fred Wilson, or James Breyer on analytical skills, they all underscore the importance of having an entrepreneurial mindset and that ability to rigorously assess a company's critical milestones. Are they hitting them?
That makes a lot of sense. VCs aren't just writing checks, they're becoming partners with these founders, right?
Yeah.
Now, what about actually having started a company yourself? Is that essential to be a good VC?
That's an interesting debate in the sources. David Cowan, for example, he pushes back against the idea that prior entrepreneurial experience is an absolute must. He argues that while entrepreneurs have specific domain expertise, those domains are constantly evolving in the venture world. Things change so fast. He also notes, and this is interesting, that former operators can sometimes find it difficult to transition to a coaching role. Maybe they become too hands-on or impatient with the pace. Some former entrepreneurs in the book even echoed this, acknowledging the challenges of moving from being the player to being the coach.
So it's maybe less about having been a founder and more about having that underlying entrepreneurial drive and those sharp analytical abilities.
Precisely. And sometimes less conventional factors can play a surprising role. There's this anecdote about Alex Benayan, who landed a VC associate role at just 20 years old, his key assets. According to the firm, it was hustle and self-confidence. They needed someone on the ground, tracking emerging startups in LA, and they figured a young, energetic connector would be more effective than, say, established VCs flying in.
Wow, that's unexpected. Hustle and self-confidence as your ticket into VC.
It really underscores the importance of tenacity. That drive. David Cowan's passport story is a great kind of extreme example. He realized his passport was expired the day before a crucial international flight. He didn't just give up. He went to extraordinary lengths, pulling every string imaginable, trying to get it renewed and still make his flight. That kind of never take no for an answer attitude seems to be a pretty common thread.
It sounds like it can be a really intense job then, beyond just finding the promising deals. Emotionally intense.
Absolutely. It's described as both emotionally and intellectually demanding. You're dealing with a lot of rejection. It's fundamentally a business of 1,000 no's. Jack Aarons, a VC with decades in the field, says he's basically stopped trying to micromanage his schedule. Instead, he maintains a prepared mind for emergencies that may arise on any day. You really need significant mental resilience, fortitude.
And it's definitely not a get-rich-quick scheme, right? It takes time.
Definitely not. John Doerr famously compared training a new VC to preparing a fighter pilot for combat. He said it takes 6 to 8 years, and you have to be prepared for losses along the way. That long-term view is crucial, although the book does contrast this with some examples of really early fund successes. Like Hummer Winblad's first fund, apparently 16 out of 17 investments generated positive returns, which is pretty remarkable. And Arboretum Ventures Fund also achieved quick exits and landed in the top performance tier. So, well, it's a long game. Early wins are possible.
Speaking of potential riches, The book does touch on how VCs are actually compensated, right? I'm always curious about the structure, the financials.
Yes, there's a table outlining typical compensation. It includes salary, bonus, and this key component called carried interest, or carry. Carry is essentially the VC's share of the profits the fund generates. It's often the biggest potential upside for them. And interestingly, the vesting schedule for that carry is usually tied to both the investment period, typically the first 5 years or so when they're making the investments,
Right.
and the harvesting period, which is roughly years 6 through 10 when the portfolio companies are hopefully being sold or going public. This long vesting period helps ensure the VC team's incentives are aligned with the long-term success of the fund and its LPs.
Okay, so it really is a marathon, not a sprint, but with a potentially significant reward if you back the right companies. But how do people actually break into this industry? It sounds pretty exclusive.
Yeah, the book shares some fascinating stories there. John Doerr famously just started cold calling venture firms looking for an apprenticeship.
Yeah.
It didn't immediately land him a role at Kleiner Perkins, the big one, but he eventually got there after getting some operating experience first. Brooks Byers, who initially told Doerr to get that experience, later invited him for a 5:30 a.m. run, apparently as a test of his commitment.
Wow. 5:30 a.m. run for an interview.
Seems like it. And Robert Nelson's pursuit of Brooks Byers is another great story of persistence. He reportedly cold called him maybe 100 times, and even used Pratt's Guide to Venture Capital Sources, like a directory, to educate himself. He eventually co-founded ARC Venture Partners, a major firm.
Incredible. Persistence definitely pays off. And the Kauffman Fellows Program is also mentioned as a path in.
Yes, that's presented as a more structured pathway. It's a 24-month, very hands-on program. Includes professional coaching, mentoring, a whole industry-focused curriculum. It's highly competitive, though. They look for people with a strong track record already, and entrepreneurial experience is highly valued there.
Any practical advice for someone trying to break in today? Any takeaways?
Absolutely. One key piece of advice that stood out was to target the junior team members first, like senior associates or principals, for your initial outreach, rather than going straight to the top, the senior partners. The thinking is the junior folks are often more hungry. They're driven to find promising deals to build their own track record, whereas the more established VCs might already have their reputations and networks pretty well secured. As the book quotes someone saying, junior people will give entrepreneurs a fair shake because they need good deals to their name. They are motivated in a way more seasoned VCs are not.
That's actually really insightful, kind of counterintuitive, but makes sense. The chapter wraps up with a quote from Sanford Bernstein saying something like, some VCs can do it, some can't, and like athletes, you can't really tell till they take the field. Sounds like there's definitely an element of innate talent, maybe even luck, involved too.
Yeah, that captures it well. It's a tough business to predict success in.
Okay, so now that we have a better sense of what it takes to be a VC, let's shift gears. Let's explore who actually provides them with the capital to invest, the money behind the money managers.
Exactly. A very fitting transition. Now we move to Chapter 4, which explores the universe of limited partners. These are the entities that actually provide the capital to venture capital funds.
Okay, so while VCs are out searching for the next big company, they themselves are being sought after for funding by these LPs, or rather, they're seeking funding from the LPs.
Precisely. Venture capitalists raise their funds from limited partners, or LPs. These LPs include big institutional investors, think pension funds, foundations, university endowments, banks, insurance companies, but also family offices and high net worth individuals. Figure 4.1 in the source lays this out. And interestingly, pension funds typically provide a really significant chunk of the overall capital invested in venture funds globally.
And what are these LPs primarily looking for when they decide, okay, we're going to invest in this specific VC fund?
Well, their primary objectives are generally twofold. Minimize risk as much as possible and achieve their target financial returns. For a VC fund manager, attracting the right mix of LPs is crucial. It's described as a bit like matchmaking. First-time funds, especially those run by first-time managers, often find it easier to get their initial capital from individuals and family offices. It can be harder to get those big institutional checks right out of the gate.
Why is that exactly? Are the big institutions just inherently too risk-averse for brand new funds?
That's part of it. Institutional investors, they have a fiduciary duty, right? They're managing huge pools of money, often for retirees or charitable causes, very prudently. Investing in a new, unproven fund naturally carries more perceived risk. And the book points out, venture funds aren't just competing against other venture funds for this LP capital, they're competing against a whole universe of other asset classes, stocks, bonds, real estate, hedge funds that might offer a more favorable risk-adjusted return profile. Venture capital falls under this broader category of alternative assets, which Table 4.1 outlines. It includes private equity, hedge funds, real assets. These are things like private equity and hedge funds that aren't traded on public markets. They often involve longer investment horizons and, crucially, less liquidity.
Right, I've heard that term alternative assets. So venture capital is just one slice of that bigger pie for these large investors.
Exactly. And within private equity itself, venture capital often represents a smaller allocation for most LPs compared to, say, large buyout funds. One of the key characteristics you mentioned is illiquidity. That's huge for private equity and venture capital. Unlike stocks you can sell any day, investor capital is typically locked in for a long time, sometimes 10 years or even more. It's not easy to just sell your stake. So to compensate for tying up their money and not being able to trade it easily, investors demand what's called an illiquidity premium. Basically, they expect a higher potential return compared to more liquid assets like public stocks. The Sharpe ratio, which is mentioned in Figure 4.3, is a way they measure this, essentially return relative to the risk taken.
That makes perfect sense. Tie up your money for a decade, you'd better expect a potentially bigger payoff for that lack of flexibility. The book mentions a mock 60-40 portfolio and this Sharpe ratio comparison. What's that illustrating?
Yeah, Figure 4.3 shows a hypothetical portfolio and compares the Sharpe ratios across different potential asset allocations. It helps LPs visualize and evaluate the trade-offs between risk and potential reward when adding things like venture capital to their mix. And the whole concept of liquidity itself is interesting. It's been debated for ages. The book quotes John Maynard Keynes way back in 1964 talking about the antisocial fetish of liquidity, suggesting that focusing too much on easily tradable assets isn't always best for the overall economy. And David Swensen, the famous Yale endowment manager, echoed this. He observed that liquidity often vanishes precisely when you need it most, like during a big market crash.
Interesting perspectives. So, beyond just the general risk-return profile, do different types of LPs have different specific motivations or constraints, like foundations versus family offices?
Absolutely they do. Foundations, for example, manage these large endowments, often from philanthropic gifts, and they're typically required by law to grant a certain percentage, often around 5% of their assets each year, to charities to maintain their tax-exempt status. So the other 95% gets invested using various strategies. Their investment decisions need to both align with their mission and generate enough return to meet those grant obligations. Family offices, on the other hand, which can be single-family SFOs or multifamily MFOs, their main focus is usually preserving and growing the wealth of the specific families they serve. And minimizing tax impact is often a big consideration for them. They might have more flexibility and sometimes a higher risk tolerance compared to, say, a public pension fund.
Okay, got it. And what about these fund of funds that are mentioned? What role do they play?
Fund of funds, or FUFs. They became pretty prominent starting in the late 80s. They were seen as a more efficient way for large financial institutions to get exposure to private equity and venture capital. Instead of trying to research and invest directly in dozens, maybe hundreds of individual venture funds, they invest in a portfolio of these funds, a fund that invests in other funds.
So it's like a VC fund that invests in other VC funds. That sounds a bit meta.
It is, in a way. But it offers several advantages for those big institutional investors. It gives them efficient access to a diversified range of managers, sectors, geographies, and even fund vintage years, without needing a massive internal team to manage all those individual relationships. Figure 4.5 in the source shows a typical asset allocation strategy for a fund of funds. And the book highlights different Foki models too. For example, you have firms like Adam Street Partners offering these large, diversified global funds. Then you have others like Sendana Capital, which specifically focuses on investing in micro-venture capital funds. Those are typically smaller funds, maybe under $100 million, targeting seed-stage companies. Michael Kim, Sendana's founder, has deep roots in the Silicon Valley startup scene and connections to the San Francisco Employees Retirement System, SEVRS.
It sounds like even the fund-to-funds world is evolving. The book mentions a shift towards adding more value, not just allocating capital.
Yes, exactly. Christopher Reisig of RVCF emphasizes this point. He says the focus is shifting beyond just passively providing capital. It's more about actively adding value for their LPs, the venture funds they invest in, and even the underlying portfolio companies those funds back. For instance, his firm hired a dedicated business development director. Their job is specifically to help connect their portfolio VC funds with their own investors to create strategic opportunities, like customer introductions or partnerships.
So really understanding the diverse motivations, constraints, and even the specific models of these different types of LPs seems absolutely critical for any venture fund trying to raise money.
It's fundamental. You have to know your audience.
Okay. Now that we have a clearer picture of who these limited partners are, let's turn our attention to Chapter 5. How do LPs actually conduct due diligence on the venture capital funds themselves?
Right. So the tables are turned. Now it's the LPs doing the scrutinizing.
Makes perfect sense.
Yeah.
They're putting millions, sometimes hundreds of millions, into these funds.
Exactly. LPs are proactively seeking out experienced fund managers they can trust, people who can be good stewards of their capital and, crucially, deliver strong investment returns. Now, some LPs might really prioritize investing only in established top-performing funds with long, proven track records, the brand names. But others might actively seek out promising emerging managers' first-time funds who could bring fresh perspectives and potentially higher growth opportunities down the line. And it's important to remember, the ability of any fund to raise capital is also heavily influenced by broader market conditions. Is the economy booming or busting?
Okay, so what are the key areas that LPs really scrutinize when they're evaluating a potential VC fund investment?
Chapter 5 outlines that LP due diligence primarily focuses on three interconnected things: performance, people, and strategy. Performance is obvious, the track record. People means the expertise, the stability, the skills of the general partner team, the GPs. And strategy covers the fund's sector focus, its timing in the market, and how it plans to construct its investment portfolio. Number of deals, size of deals, etc.
Let's start with that first step, sourcing and first screens. How do LPs even begin to narrow down the huge number of potential VC funds out there?
Well, as I mentioned, some LPs aim for those proven top-tier funds, while others actively look for emerging managers. Some might start by identifying specific sectors they want exposure to, say cybersecurity or biotech, and then filter funds based on that, plus other criteria. But for most LPs, the primary initial filter tends to be past performance. How has this team done before?
So track record is really the gatekeeper at the beginning.
It's certainly a major factor in that initial screening. Lisa Edgar of Top Tier Capital Partners, which is a fund of funds, she says she prefers to begin her screening with a focus on performance. She emphasizes the importance of a manager's ability to generate superior returns consistently across different tech trends and economic cycles.
And what about the experience level of the VC firm itself? Does the number of previous funds they've managed, Fund 1, Fund 2, Fund 3, matter?
Oh, it definitely does. Jorgan Perkins of Fisher Lynch Capital, another fund of funds, she mentions looking for firms that are a Roman numeral V or higher, meaning they've successfully raised and invested capital through at least 4 previous fund cycles. That indicates an established track record, a brand, connections within the investment community. She apparently reviews hundreds of fund documents each year to pick just a handful of investments.
Wow. Hundreds. Okay, so after that initial screen based on performance and maybe experience level, what's the next stage? Evaluating the venture firms. What happens then?
This stage involves a much deeper assessment. It's about understanding how the fund manager's specific skills and expertise align with the market opportunities they're targeting. Essentially, do they have the right team and the right approach to actually generate those superior financial returns they're promising? The book notes that most VCs use what are called emergent strategies. They have a general framework, but they stay flexible to jump on unexpected opportunities.
It sounds like LPs are really looking for a differentiated investment approach then, not just another fund doing the same things everyone else.
Absolutely. That's a huge theme. Chris Duvos, who's an LP in several top funds, points this out really clearly. He says while there are tons of smart people in venture, true differentiation is often lacking. He says something like, being smart is necessary but not sufficient. Partners often can't demonstrate resonance between their backgrounds and their investment strategy. It needs to connect. Adam Street Partners, the large fund of funds, they focus heavily on the quality of the group's deal flow, looking at both the intrinsic quality of the deals they see and the level of competition for those opportunities.
So it's not just about having a unique investment idea, it's about whether the team has the actual capabilities, the network, the access to capitalize on it effectively.
That's exactly right. Chris Rissick of Renaissance Venture Capital Fund sums it up nicely. It all boils down to 2 things, the people and their investment strategy. But just to show the challenge, the book also shares this funny anecdote from an LP who feels like a pretty woman in a bar because they hear the same repetitive pitches over and over again. It really highlights the challenge for GPs to truly stand out and clearly demonstrate that crucial differentiation.
That's a memorable analogy. It really emphasizes the intense competition for that LP capital. Okay, now that we understand how LPs evaluate VC funds, let's explore what actually defines a fund's investment strategy in Chapter 6.
Right. A clearly defined investment strategy is absolutely essential for a venture fund trying to attract those discerning limited partners. It needs to provide clarity. What types of companies will the fund invest in? And crucially, what's the rationale? Why do they believe this strategy will achieve attractive returns?
The chapter mentions sector-based strategies. Have those become more important over time? Was it always like this?
Yeah, significantly more important now. James Schwartz, one of the founders of Excel Partners, he recounts that back in the 70s and 80s, when maybe capital wasn't quite as competitive, having a super specific sector focus wasn't as critical. He said the early focus on communications and software wasn't some deep foresight. It was more just being comfortable in those emerging areas. But as the venture landscape has matured and become way more competitive, having that well-defined sector focus is well more important now. It helps demonstrate real expertise and attract the right LPs. Today, you see popular sectors like social media, gaming, cloud computing, AI, biotech. They attract tons of investment.
So it's really about identifying and deeply understanding specific areas that have high potential for growth and disruption, finding your niche.
Precisely. And the book introduces Peter Drucker's concept of systematic innovation. He identified 7 sources of opportunity, which are outlined in Table 6.1. Things like unexpected successes or failures, demographic changes, new knowledge. These provide a valuable framework for VCs trying to spot potential areas for innovation and strategic investment.
I'm intrigued by this white space research strategy that's mentioned. What exactly does that involve? Sounds proactive.
It is very proactive.
Yeah.
And quite sophisticated. It's an approach where some leading VC firms conduct really in-depth research themselves to identify unmet needs or emerging market trends before everyone else sees them. And then they might actively create or co-found startups specifically to address those identified opportunities. It's like forging a new path instead of just following existing ones. The Ralph Waldo Emerson quote about paths and trails fits here. John Jarve of Menlo Ventures notes that over half the companies they invest in actually originate from their own internal research efforts. It shows how research-intensive their approach is.
Wow, that's fascinating. It's almost like having a venture creation studio embedded right within the VC firm itself.
It kind of is. And Bessemer Venture Partners, another top firm, employs a different but related methodology they call roadmap investing. David Cowan describes his experience developing these detailed roadmaps for potential high-tech investment sectors. He'd systematically narrow them down based on factors like the depth of expertise needed, the market maturity, the level of competition already there. He really emphasizes the importance of a thorough think-before-I-fund process. That involves seeking advice from industry experts, surveying potential customers, really doing the homework up front.
So different firms definitely have their own unique methodologies for defining where they'll play. Beyond just the sector, what other key elements are part of a fund's investment strategy?
Stage and geography are also critical elements you'll see defined. A fund might specialize only in seed stage investments, those very first checks into a company. Or maybe they focus on later stage growth equity for more established companies. Similarly, they might concentrate their investments in a specific geographic region, say just Silicon Valley or the Midwest or Europe, leveraging their local networks and understanding of those regional dynamics.
Okay. Defining that niche sector stage geography seems crucial then, both for attracting the right LPs and for the fund's own operational clarity and focus.
Absolutely. It guides everything they do.
Now let's move to Chapter 7, which discusses how institutional investors evaluate fund managers. We touched on the people aspect during LP due diligence, but this chapter seems to dive deeper into evaluating the actual individuals leading the fund.
You're right. While the performance track record and the investment strategy are paramount, institutional investors place enormous weight on the fund management team itself. The GPs, Chapter 7, specifically examines the dynamics within that team, focusing on their stability, how their skill sets complement each other, and the alignment of their interests. Are they all pulling in the same direction? Stability seems like an obvious concern for LPs. Nobody wants to invest in a fund where the key partners might just jump ship halfway through. Exactly. Newly formed partnerships, first-time funds, they're often perceived as inherently riskier for this reason. LPs will meticulously assess each individual partner's background, their expertise, their track record. But maybe even more importantly, they'll evaluate how those individual pieces fit together. Do they form a cohesive, stable team? Is there chemistry? If the partners don't seem to work well together, or there's potential for conflict, that can be a huge red flag for investors.
And what about the actual skills and expertise of the team members? Do LPs generally prefer managers who are generalists, dabbling in many sectors, or specialists with really deep knowledge in specific areas?
That's a great question. The research highlighted in the book strongly suggests a preference for specialists, particularly when it comes to early-stage investing. There was a study by Paul Gompers, Anna Kovner, and Josh Lerner that found a significant positive correlation between the degree of specialization within a firm and its overall success. Investment professionals with deep expertise in specific sectors working within specialist firms tended to outperform generalists. And interestingly, the study also concluded that prior entrepreneurial experience and deep domain expertise are strong predictors of future fund performance. However, just putting a specialist inside a generalist firm didn't yield the same strong positive results. The whole firm context matters.
That makes intuitive sense, doesn't it?
Yeah.
You probably want the people making multi-million-dollar bets in, say, biotech to really understand biotech. The chapter also mentions the importance of soft skills and social networks. Are those becoming more critical?
Yes, those are increasingly recognized as crucial attributes, absolutely. Soft skills, things like strong communication, negotiation abilities, good interpersonal skills, they're vital for building strong relationships with entrepreneurs, with co-investors, with everyone in the ecosystem. And having a robust social network can provide invaluable access to deal flow, industry insights, potential acquirers down the line. It's not solely about the technical financial modeling skills. It's also very much about navigating the complex human dynamics of the venture capital world effectively.
So LPs are essentially trying to figure out if this VC team possesses the right combination of experience, deep expertise in the areas they claim, and those strong interpersonal skills. Not just to pick the right companies, but also to effectively support them and work well together over maybe a decade or more.
Precisely. They're looking for a team that has the potential to not only survive, but to thrive together over the long lifespan of the fund. It's a long-term partnership.
Okay. Now, let's move on to Chapter 8, which gets into the important considerations of fund size and portfolio construction.
Right. These are very practical but critical elements.
Fund size is something I've often wondered about. Is there, an optimal size for a venture capital fund? Or does it just vary wildly?
It's definitely not a one-size-fits-all answer. The ideal fund size is really closely linked to the fund's specific investment strategy. The typical capital needs of the companies it plans to back, seed versus late stage, for example, and also the preferences and capacity of its limited partners. Institutional investors, especially the really big ones managing massive portfolios like pension funds or sovereign wealth funds, they often have a preference for investing in funds above a certain minimum size, typically around $100 million or more, just for efficiency in managing their overall portfolio and the relationships. It takes as much work to diligence a small fund as a large one.
So smaller, newer funds might face a bit of a challenge in attracting investment directly from those giant institutional players, at least initially.
That can certainly be a hurdle for smaller funds, yeah. Although, as we discussed, there are definitely LPs, like some fund-of-funds or family offices, who specifically do focus on investing in emerging or micro VC funds. Chapter 8 then goes on to explore the critical aspects of portfolio construction. This involves several key decisions for the fund managers.
Okay, what are the main factors that VCs need to think about when they're actually building out their investment portfolio? How many companies, how much in each?
The key considerations include the total number of individual investments the fund plans to make over its life. Is it 15? Is it 50? The degree of diversification across different sectors, stages, maybe even geographies. A really important one is the allocation of capital reserve for follow-on investments in their most promising portfolio companies. These are often called reserves. And finally, the overall pacing of their investments. How quickly did they deploy the capital over the fund's investment period, usually the first few years?
It sounds like a really delicate balancing act. You need enough diversification to spread the risk, but also enough concentration in your potential big winners to generate those significant returns everyone's hoping for.
Exactly. That's the art and science of it. The book emphasizes the importance of building a high-quality portfolio relatively early in the fund's life, typically within the first 4 to 5 years after launch. That's when most of the initial investments happen. And for emerging managers, those first-time funds, identifying and investing in a company that can achieve a really significant exit, think 10x return on their money within maybe 3 to 5 years. That's often crucial for demonstrating early success and making it easier to raise their next fund.
And let's face it, not every investment is going to be a home run, right? How do VCs approach the inevitable losses in their portfolio, the ones that don't work out?
That's a critical aspect of managing a venture fund. The book stresses the importance of just acknowledging that losses are inherent in this business. You will have write-offs. And having a disciplined approach to knowing when to, let go of underperforming companies. Cut your losses. David Cowan is quoted saying something like, just focus on your top 5 companies. The rest is distraction. However, the book also points out this common human tendency among GPs to become overly attached to their investments. They call it falling in love with their own cooking. And sometimes they might ignore early warning signs in struggling portfolio companies because they're so invested emotionally and financially. Recognizing and addressing those losses early allows the fund to reallocate its time, its capital, its resources towards the more promising ventures.
So it's about being deeply committed and supportive, but also objective enough to make tough calls when necessary. The chapter also briefly touches on how the size of a potential investment in a fund fits within an LP's overall investment portfolio.
Yes, that's an important consideration from the LP side. An LP will look at the size of a potential commitment to a specific VC fund relative to the overall size of their own portfolio, and also relative to their existing allocations to the venture capital asset class. A huge pension fund, for example, might find it inefficient to make a tiny $5 million allocation to a micro VC fund. It might not move the needle on their overall returns and just increases their administrative burden. The overall market timing also plays a role in determining fund sizes and LP allocation decisions. Are we in a bull market or a bear market? And finally, the chapter briefly mentions the reasons why LPs might choose to terminate their relationships with existing VC funds. This could be due to consistent underperformance, significant changes in the GP team, like key people leaving, or major shifts in the LP's own overarching investment strategy.
Wow. All of these factors really underscore the intricate and dynamic relationship between venture capital funds and their limited partners. It's complex.
That truly is a constant negotiation and alignment exercise.
Okay, now let's move on to Chapter 9, which focuses on the absolutely crucial aspect of performance analysis. This is ultimately how success or failure is judged, right? The bottom line.
You're absolutely right. LPs rigorously, meticulously analyze the performance of their venture capital investments. They look at it at the overall fund level, but also increasingly at the individual performance of the key investment professionals within the fund. This detailed analysis is essential for informing their future investment decisions. Should we reinvest with this team or look elsewhere?
What are the primary metrics that LPs use to evaluate the performance of a venture fund? What are the key numbers they look at?
The 2 main metrics you'll always hear about are the internal rate of return, or IRR, and the cash-on-cash multiple, often abbreviated as COFI, or sometimes MOIC, multiple on invested capital. The IRR represents the annualized rate of return on the capital invested. Think of it like the speed of the returns. While the COFI multiple shows the total amount of cash returned to investors for every dollar they initially put in, that's about the overall magnitude of the profit. Table 9.2 provides an example.
So LPs are looking at both how quickly they get their money back and generate returns, IRR, and how much profit they ultimately make overall.
Exactly. You really need both to get the full picture. A high IRR on a small return isn't as good as a slightly lower IRR on a huge return. Now, while the book presents fund-level performance, LPs typically evaluate these metrics in comparison to relevant benchmarks. How did this fund do compared to its peers? However, it's often the LP who prefers to select the specific benchmark they deem most appropriate. Table 9.3 shows some examples for early-stage U.S. funds. Bob Clone, who has extensive experience managing GP relationships, emphasizes the importance of getting cash flow data at the individual portfolio company level, not just aggregated fund-level numbers. He wants to see the underlying drivers. The Institutional Limited Partners Association, ILPA, has even developed reporting guidelines trying to improve transparency and standardize this data. It's an ongoing effort.
The chapter also mentions public market equivalence, or PME. What's that about?
Yeah, PME is a method used to compare the performance of a private fund, like a venture fund, to what an investor might have earned by investing in a public market index, like the S&P 500, over the same period. A PME greater than 1 suggests that the investors did better in that VC fund than they would have just putting the money in the public stock market. It's a way to judge the value add of private markets. Professor Stephen Kaplan's research highlights various sources for this kind of performance data: Prekin, Cambridge Associates, Burgess. He notes that Burgess data, derived directly from institutional LPs, tends to be the most reliable, the cleanest. And interestingly, analysis of that Burgess data over decades, shown in Table 9.4, indicates that venture capital has historically outperformed the S&P 500 on average, though performance varies hugely between funds.
The historical outperformance is often the core argument for why LPs allocate capital to venture in the first place, despite the risks and illiquidity. But it sounds like establishing truly meaningful benchmarks isn't always straightforward. There's ambiguity.
You're right, it's not simple. The criteria for benchmarks can be inconsistent. Definitions can be interpreted differently. For example, what exactly constitutes a top quartile fund? That can vary significantly. Is it based on the net IRR? Or the COSI multiple? You can have funds with really high IRRs because of quick, smaller exits, but maybe lower overall COSI multiples, and vice versa, so it gets top. The book also mentions, maybe cynically, the practice of some funds selectively omitting their worst-performing investments from their reported track record to artificially inflate their performance indicators, making themselves look better.
That sounds a bit like cherry-picking the data. Not great transparency. What about evaluating the individual performance of the investment professionals within a VC firm? How do LPs look at that?
That's also a critical piece for LPs, especially when deciding whether to back a firm's next fund. Who are the real stars on the team? Individual performance is typically assessed across several key dimensions. Their ability to source promising deals, finding the diamonds in the rough, their effectiveness in executing those deals, structuring, negotiating, winning the deal, and their track record in achieving successful exits, getting the returns back. Table 9.1 shows a sample format for how this might be tracked. And the case study of technology tools for email and social media marketing gives an example of the kind of portfolio company info used to assess individual contributions. Ultimately, the book notes that individual performance in VC is inherently competitive. It can lead to a culture with celebrated heroes who source the big winners and then the also-rans.
It sounds like LPs are really digging deep into the numbers, the track records, both at the fund and individual level, trying to identify those truly exceptional venture investors who can consistently deliver.
They absolutely have to. The stakes are too high not to.
Okay. Now let's turn our attention to a specific segment of the VC wind discussed in Chapter 10. Emerging managers. A promise of the future.
Right. Emerging managers. These are essentially venture capital fund managers who are raising their very first fund, first-timers. While they obviously lack that long established track record, they can often present unique investment opportunities and potentially high returns for certain types of limited partners.
Mike Maples is quoted in this chapter with a pretty stark view. I expect most VCs to fail. The entire business is about finding exceptional, awesome companies. If you find one of them every 5 years, nothing else matters. That really sets the stage for the high-risk, high-reward nature of the whole business, and it seems particularly relevant for these first-time fund managers trying to prove themselves.
It does, absolutely. The pressure is immense. The chapter also points out the cyclical nature of investments in tech and life sciences. One sector might be hot while the other is cold. Emerging managers, as Kelvin Liu of Invesco writes, often have stronger intrinsic motivations. He mentions creativity, hunger, and performance. Perhaps because they don't have the cushion of past successes or the burden of past failures. They have everything to prove. Henny Netta's experience starting GGVI right after the dot-com crash is a compelling example. An emerging manager seizing an opportunity when established players were maybe licking their wounds.
So who typically invests in these emerging managers? Is it the big, established institutional LPs? Or is it more often the smaller players, maybe individuals?
Typically, emerging managers often attract their initial investment from high-net-worth individuals, family offices, and sometimes government-related funds, rather than some of the larger, more conservative institutional investors, at least for that very first fund. However, fund of funds are often more willing to invest in emerging managers. Some funds even have specific mandates or targets to allocate a certain portion of their capital to these first-time funds, as shown in Figure 10.3. And even major institutional investors like CalPERS and CalSTIRS, the huge California pension funds, actively seek out and invest in emerging manager-led funds. They view it as a way to gain early access to potentially high-growth firms before they become household names, and also to diversify their overall venture portfolio. Russell Reed of CalPERS is quoted saying they aim to find these promising firms on the small end of their asset class before they get too big and competitive.
What are the potential advantages, then, for LPs who decide to take a chance and partner with these emerging managers? What's the upside for them?
Investors cite several potential benefits. One is the opportunity for early access to potentially high-growth companies, maybe before they become widely recognized and the valuations get driven up. Another is the potential for higher returns, as emerging managers are often incredibly hungry and highly incentivized to demonstrate strong performance right out of the gate. They might also have access to more proprietary deal flow, perhaps being closer to newer emerging areas of innovation than established firms. And sometimes a management focus that is more intensely geared towards maximizing profits rather than just growing assets under management, AUM.
The chapter also mentions Dave McClure and 500 Startups High-Volume Investment Strategy. How does that fit into this landscape of emerging managers? Is that typical?
Dave McClure's approach with 500 startups, which involved making a very large number of relatively small early-stage investments across many different geographies. That represents a somewhat unconventional model, especially for an emerging manager at the time. His thesis was basically that this high-volume, diversified strategy could lead to more consistent overall returns, even if the individual home runs might be smaller compared to the concentrated bets of traditional VCs. It's a different philosophy of portfolio construction compared to the more typical emerging manager model of making fewer, more concentrated investments.
Interesting. It sounds like the emerging manager space is a really dynamic area where the LPs can potentially uncover hidden gems, but it definitely comes with its own unique set of risks and requires a specific kind of diligence.
Absolutely. Higher risk, potentially higher reward, and requires a different kind of conviction from the LP.
Okay. Now let's move to Chapter 11 and delve into the venture capital firm, operations and culture. We've talked strategy and people, but how does the firm itself function?
Right. Beyond just the investment strategy and the individuals on the team, the operational infrastructure and the overall culture of a venture capital firm are increasingly recognized as really important factors. They contribute to long-term success, the ability to attract top LPs, and also to attract and retain talented investment professionals.
Andreessen Horowitz, A16s, is highlighted in this chapter as setting a new services standard in the venture industry. What exactly does that mean? What did they do differently?
Well, Mark Andreessen is quoted saying, "They aim to create the venture firm we as entrepreneurs would have taken money from had it existed at the time." That really reflects their core philosophy, providing extensive services and support to their portfolio companies that go way beyond just writing a check. They built this large internal team with deep expertise in areas critical to startups, talent acquisition, marketing, business development, technical strategy. They act almost like strategic consultants or partners to their portfolio companies. The book draws parallels with talent agencies like CAA in Hollywood, known for aggressively recruiting top talent, and Ellen Company's famous Sun Valley Conference, which brings together influential leaders. Andreessen Horowitz even developed what they internally called HR in a Box, a dedicated team of expert recruiters solely focused on helping their portfolio companies find and hire the best people.
Wow, it sounds like they tried to be much more than just a source of funding, really an integrated strategic partner for growth. What about other firms? Does First Round Capital have a similar approach to adding value?
First Round Capital also places a huge emphasis on adding value beyond capital, yeah. But their approach is maybe more focused on building products, hosting events, and creating services that facilitate connections among their portfolio companies. Building a community. Josh Koppelman highlights their dedicated team focused on this, the software tools they've developed internally, and their very active online network. It allows founders and functional experts within their portfolio engineers, marketers, sales leaders to interact, share valuable knowledge, best practices, solve problems together. This creates a powerful network effect where each new investment arguably strengthens the value proposition for all the existing portfolio companies.
So fostering a strong sense of community and facilitating that peer-to-peer knowledge sharing among the companies they've backed. That makes sense. What about the more behind-the-scenes operational stuff, the back office of running a VC firm?
Yeah, the chapter touches on those essential back office functions too. They're critical for the smooth operation of any investment fund, even if they're less glamorous. This includes things like preparing regular investor communications, fund performance updates, detailed investment reports for the LPs, and also managing complex audits and tax compliance. A robust and efficient back office is crucial for accurate financial reporting and meeting all the regulatory requirements. The book also presents a sample carried interest investing schedule in Table 11.1. We talked about carry earlier. This shows how profits are shared and how incentives are structured long-term. And finally, it briefly outlines the typical steps involved in formally closing a new fund. That involves finalizing all the legal agreements with the LPs and then the actual wire transfers of capital. It sounds like building a successful VC firm requires not only a compelling investment thesis and a talented team, but also a really well-organized operational infrastructure and a supportive culture, both for the fund's own people and for its portfolio companies. Exactly. It's a whole ecosystem they're building and managing.
Okay, now let's move to Chapter 12, which covers fund marketing materials. How do funds actually pitch themselves to get that LP money?
Right. Just like startups need compelling materials to attract venture capital, venture funds need effective marketing materials to attract limited partners. It's a sales process, too. And the process of fundraising often begins well before the fund is even formally established. They start socializing the idea early.
Ravi Mohan of Shasta Ventures recounts their experience meeting with around 200 potential investors just to reach their target fund size for their first fund. Sounds like a huge effort.
It's a massive undertaking, especially for a first fund. Very time-consuming.
So what are the essential marketing tools that a fund needs to have ready when they go out to raise capital?
The chapter highlights 3 key marketing tools that are pretty standard. First, the Private Placement Memorandum, or PPM. It's a very comprehensive legal document, kind of like a detailed business plan specifically for the fund. Second, a concise and persuasive presentation or slide deck, the pitch deck. And third, a brief executive summary, typically just 2 pages, providing a high-level overview of the fund's strategy, team, and key terms.
What are the key elements that these marketing materials really need to communicate effectively to impress potential LPs?
Well, a well-crafted PPM, the big document, will cover a lot of ground. At a minimum, the fund's thesis on the market opportunity and its specific investment strategy, a detailed explanation of the fund's investment process, how they source, diligence, invest, and support companies, comprehensive information about the organization itself, and crucially, the experience and track record of the management team, summaries of selected past investment transactions, if they have any, to show examples, the specific terms of the investment in the fund fees, carry, etc., and a thorough section outlining the various risks and relevant regulatory considerations. That's the legal stuff. Now, while the legal and term sections of the PPM tend to be the longest, the book emphasizes that potential investors will primarily focus their attention on the sections detailing the team, their experience, track record, the fund's demonstrated performance, if any, and the clarity and rationale of the investment strategy. Those are the core pillars.
So, those 3: team, performance, strategy, that's where the fund really needs to shine and articulate its unique value proposition to build confidence with potential LPs. The chapter also advises on the importance of the overall presentation, like literally how the documents look, and avoiding errors.
Yes, absolutely. The book stresses the importance of professional, well-designed packaging for all the marketing materials. It reflects on the firm's quality, and absolutely 0 grammatical errors or typos in the documents. One LP is quoted saying that finding errors in a fund's documents is definitely not a positive first impression. It can seriously erode investors' confidence in the fund's overall attention to detail and operational capabilities if they can't get the PPM right.
Right. Attention to detail clearly matters in every single aspect of this business. Okay. Now let's move to Chapter 13. This delves into the crucial legal agreement that governs the whole relationship between the venture capital fund and its investors. Terms of investment. The Limited Partnership Agreement, or LPA.
Yes, the LPA. This is the foundational legal document. It outlines all the rights, the responsibilities, the obligations of both the general partners, the VCs managing the fund, and the limited partners, the investors. It essentially governs every significant aspect of the fund's operations, from fees to conflicts of interest to how decisions are made.
Yeah.
And it's typically subject to considerable negotiation between the GPs and the LPs.
Table 13.1 lists the key elements that LPs typically negotiate hard on in an LPA. What are some of the most important of these terms? The big ones.
Several elements are critically important and almost always negotiated. These include the total size of the fund and its overall term or lifespan, usually 10 years, maybe with extensions. The management fees charged by the GPs. The carried interest, the GPs share the profits and how it's calculated. Key person provisions what happens if a critical partner leaves. Potential conflicts of interest and how they'll be managed or disclosed. Various governance matters, like advisory committees, and the specific conditions under which the fund can be terminated early.
Let's break down a few of those key terms. Management fees, what's considered typical in the industry for those? 2 and 20 is the classic model, right?
Yeah, 2 and 20 is the historical shorthand, though the details vary. Management fees are typically calculated as a percentage of the total committed capital to the fund, often ranging from 2.0 to 2.5% per year, especially during the initial investment period. These fees often decrease or step down after that initial investment period, say after year 5, maybe switching to being based on invested capital instead of committed capital. Although there's usually a minimum fee level to ensure the GPs have enough resources to manage the remaining portfolio of investments actively.
Okay. And carried interest, the 20 part of 2 and 20, how does that work in practice, and what are the main concerns for LPs regarding carry?
Right? Carried interest, or carry, represents the general partner's share of the net profits generated by the fund, usually 20%, but it can vary. Best practices, strongly advocated by ILPA, the Institutional Limited Partners Association, recommend that carry should be calculated based on the net profits of the fund as a whole. Meaning, after all the management fees and fund expenses have been paid back to the LPs first, this is called a whole fund waterfall, or European waterfall. LPs scrutinize how carry is calculated very closely to ensure it's directly tied to the actual investment returns achieved for them. Unlike some other types of private equity funds, like buyout funds, venture capital funds typically do not have a predefined preferred rate of return or hurdle rate that the LPs need to receive before the GPs start earning their carry. The LPs just need to get their capital back first.
Got it. Key person provisions sound particularly important for protecting the LP's investment if a star partner decides to leave. What exactly do those entail?
Key person provisions identify the specific individuals within the GP team who are considered absolutely crucial to the fund's investment strategy and its success. The indispensable people. If one or more of these designated key individuals leaves the fund, becomes incapacitated, or significantly reduces their time commitment, it can trigger certain rights for the limited partners. For example, they might get the right to suspend making further investments into new companies from the fund. Or even in some more extreme cases, they might have the right to vote to terminate the fund altogether. It's a critical protection.
The chapter also mentions the LPAC Limited Partner Advisory Committee. What's their role in governance?
The LPAC serves a really important governance function. They typically oversee potential conflicts of interest that might arise during the fund's operation. For example, if the fund wants to invest in a company where a partner has a personal interest, they might also provide input and approval on certain valuation guidelines used by the fund, and they receive regular, detailed reports on the fund's performance and overall activities. They essentially act as a representative body, a sounding board for all the LPs in the fund.
It sounds like LPs have several important mechanisms built right into the LPA to protect their investments and ensure some level of oversight. The chapter also briefly mentions sweeteners that GPs might offer sometimes to attract LPs, especially for a first fund.
Yes, particularly when raising new funds, or if fundraising is tough. GPs might offer certain incentives or sweeteners to attract those crucial early LP commitments, the anchor LPs. Liam Donohue's example of a GP contributing a pre-existing portfolio of promising investments into the new fund at their original cost is a good illustration. It shows the GP's personal commitment, skin in the game, and gives the new LPs immediate exposure to some potential upside. However, Igor Rosenblatt offers a cautionary perspective on using placement agents third parties sometimes hired to help with fundraising. He suggests some might use exaggerated claims or puffed-up cliches, which can ultimately harm the fund's credibility if they can't deliver. Due diligence on the placement agent matters too. The chapter concludes with a helpful table listing common financial terms you'd find in fund LPAs.
The LPA certainly seems like a complex, heavily negotiated legal document. It really underscores the necessity of having experienced legal counsel on both sides with the VCs and the LPs.
Absolutely critical. You don't want to get these terms wrong.
Okay, now let's move on to Chapter 14. This focuses on the crucial first step in the investment process for a VC, sourcing investment opportunities. After all, you can't make investments if you don't find promising companies to back in the first place.
Exactly. Sourcing is the very beginning of the investment life cycle, as that figure 15.1 illustrates. It's about finding those initial leads, identifying those early signals of potentially great companies. Where do the deals come from?
Brad Feld's background is highlighted at the start of this chapter. His early involvement in startups like Interliant, email publishing, his angel investing. It really emphasizes that effective sourcing often comes from being deeply embedded within the entrepreneurial ecosystem, doesn't it?
Absolutely. Brad Feld's early experiences, including his famously brief formal report on Yoyodyne, apparently just saying, "Seth's cool, business is neat, I like it," which still led to an investment. It underscores the importance of those early-stage connections and maybe even a degree of intuitive judgment back then. The chapter also notes a general shift in the VC landscape over time towards more proactive and targeted sourcing strategies, especially in today's hyper-competitive markets. You can't just wait for deals to walk in the door.
So where do VCs typically discover these potential investment opportunities? Is it primarily just attending tons of pitch competitions and demo days?
Well, while pitch sessions and demo days are certainly tactical mechanisms VCs use for sourcing, yes, the book emphasizes that the most valuable and reliable sources often lie within their existing networks. Referrals from trusted entrepreneurs they've previously backed, that's often gold. Recommendations from peer investors they respect, also very high-quality leads. Other important sources include incubators and accelerators like Y Combinator or Techstars, relationships with law firms that specialize in startups, angel investor networks, connections at investment banks, and, increasingly, university technology transfer offices. Table 15.1 lists a bunch of these.
The chapter also mentions specific organizations like Dorm Room Fund and Funders Club. What's their particular angle on sourcing deals?
Dorm Room Fund takes a very focused approach. They specifically invest in student entrepreneurs, leveraging the university ecosystem itself as their primary source of deal flow. They also provide mentorship tailored to those young founders. Funders Club operates as an online venture capital platform, concentrating its sourcing efforts primarily on startups based in Silicon Valley, using technology to connect investors and companies. These more specialized, sometimes tech-enabled models are definitely evolving the traditional landscape of deal sourcing.
And angel investors play a significant role in that early-stage sourcing ecosystem as well, don't they? The first money in often comes from angels.
They certainly do. There are hundreds, maybe thousands, of angel investor groups operating worldwide now, with a particularly strong presence in the U.S. Angels, who are typically high-net-worth individuals investing their own personal capital, often target very early-stage companies, pre-seed or seed stage, with funding needs maybe in the $100,000 to $1 million range. While they can be a vital source of initial capital and validation for startups, the book notes that angel groups often have limited resources for deep diligence or follow-on funding, and the quality of their investment portfolios can vary widely. However, a significant proportion of VCs do regularly co-invest alongside angel investors in those early-stage deals. Angels can be great partners.
Universities are also highlighted as a really rich source of potential investment opportunities, all that research happening.
Yes, absolutely. With universities investing billions globally in research each year and generating hundreds, maybe thousands of new startups based on that research, spinouts, they represent incredibly fertile ground for innovation. Robert Nelson of ARCH Venture Partners is cited as a prime example. He built a hugely successful career largely on sourcing deals directly from university labs, especially in life sciences. The story of Icaria is mentioned, where he patiently cultivated a relationship with a scientist, Mark Roth, for years before finally investing when the tech was ready. Patience is key there. And Karen Fryram's very early investment in Google, after meeting Sergey Brin and Larry Page through his Stanford University connections, also underscores the immense potential lurking within university ecosystems.
The chapter also mentions the role of venture partners in sourcing. How do they typically contribute? Are they full-time?
Venture partners are often experienced industry executives or successful entrepreneurs who work with a VC firm on a part-time or advisory basis. They're not usually full-time GPs managing the fund day-to-day. One of their primary roles is often to help the firm source promising investment opportunities within their specific areas of deep expertise and leverage their extensive personal networks. The involvement of someone like Tim O'Reilly with O'Reilly Alpha Tech Ventures, OATV, is given as an example. Someone with a vast, influential network like his can provide a significant, almost unfair sourcing advantage.
So it's really a multifaceted approach then, leveraging personal networks, institutional relationships, specialized platforms, university connections, even proactive outreach and research to identify those potential investments. The chapter concludes with some notable examples of missed opportunities too, like first-round capital apparently passing on Twitter early on. It really highlights that even the best, most experienced VCs can miss out on what turn out to be massive successes.
Well, absolutely. It's humbling. As Vinky Gannison of Menlo Ventures recalls regarding Sean Parker pitching Twitter, it can be incredibly difficult to fully recognize the disruptive potential of every single very early stage idea that comes across your desk. There's just too much noise. OVP Venture Partners missing out on Amazon early on, Warren Buffett famously passing on Intel. These are legendary examples of missed opportunities. The key takeaway seems to be that having some kind of unique, unfair advantage in sourcing, whether it's network, expertise, brand, or process, and fishing in the right pond, as Warren Buffett puts it, is absolutely critical for consistently finding those promising deals before everyone else does. Ultimately, attracting the best investment opportunities is very closely linked to a venture firm's overall brand and reputation within the entrepreneurial ecosystem. As William Elkus emphasizes, the best entrepreneurs often want to work with the best VCs.
That makes perfect sense. A strong reputation becomes a magnet for deal flow. Okay, so now that a potential investment opportunity has been sourced, the next crucial step is conducting thorough due diligence. Let's dive into Chapter 16, the art of conducting due diligence.
All right, due diligence, or DD. This is the critical, often intensive process of thoroughly investigating a potential investment opportunity. Kicking the tires, basically. The goal is to assess the strength of the management team, the viability and differentiation of the technology or product, the attractiveness and size of the target market, and the reasonableness of the company's financial assumptions and projections. Fundamentally, it's about understanding the critical why now question. Why is this the right time for this company, this product, this market? And identifying potential inflection points that could trigger significant growth. The most promising opportunities usually exhibit a strong, healthy mix of a capable team, a compelling market need, and a differentiated, scalable technology or business model.
The chapter presents a pretty comprehensive due diligence checklist in Table 16.1. What are some of the key areas that VCs typically focus on during this deep dive process?
Yeah, that checklist covers a wide range. It includes a deep dive into the product or service itself. How does it work? Is it unique? Is it defensible? An assessment of the potential customer base. Who are they? How many are there? How will the company reach them? The validity of the revenue model and the overall business model. How will they make money? Is it sustainable? Is it scalable? A thorough evaluation of a management team's experience, capabilities, and cohesion. We'll get more into that. An analysis of the company's capital efficiency. How much money do they need? How long will it last? What milestones will they hit? And the potential for long-term value creation. A detailed review of the historical financials, if any, and more importantly, the projected financials. Are the assumptions realistic? And a critical examination of the assumptions underlying potential future exit scenarios. How can investors get their money back and how much? Table 16.2 provides more specific DD questions tailored to different company stages, seed versus Series A versus later stage. It's important to note the focus of due diligence should align with the stage. You wouldn't expect audited financials from a two-person pre-seed company. You focus more on team and market then.
It sounds like a very detailed, very rigorous, and often time-consuming process. Exhausting, maybe. The chapter quotes Nassim Nicholas Taleb saying that intelligence in a complex world consists in ignoring things that are irrelevant. How does that apply here in due diligence?
That's a great point. It's about focusing your limited time and resources on the key factors, the critical variables that will truly drive the company's success or failure. Rather than getting bogged down in endless minor details or analysis paralysis on things that are unlikely to have a significant impact on the overall outcome, you need to prioritize. The story of Google Ventures stressing a scientific, data-driven approach to their deal analysis highlights the effort to bring more rigor and objectivity to the process. But the book also immediately reminds us of the inherent unpredictability of future success, using the anecdote that the iconic film Raiders of the Lost Ark was initially rejected by every major movie studio. Sometimes brilliance isn't obvious up front.
That's a great reminder. Even seemingly obvious smash hits weren't always perceived that way at the start. The chapter also provides examples of maybe unconventional investments that ultimately succeeded hugely. Things like Rap Genius, Starbucks, Dollar Shave Club. What do these examples tell us about the art part of due diligence?
They really highlight that sometimes the most promising, most disruptive investment opportunities might initially appear to be outside the mainstream, or have unconventional elements that don't fit neatly into a spreadsheet. Dollar Shave Club's rapid success, for instance, is attributed in large part to the power of their branding and that incredibly effective, hilarious, viral YouTube marketing video they launched with. It underscores that factors beyond traditional financial metrics like brilliant brand building, clever marketing, strong community engagement can be absolutely critical drivers of success, especially in consumer businesses. So while a thorough checklist and rigorous financial analysis are essential tools in due diligence, there's also this crucial element of judgment, recognizing potential, spotting disruptive innovation, understanding qualitative factors that might not perfectly fit into a traditional model.
So it's both science and art then. You need the checklist, but also the intuition and foresight.
Exactly. You need both sides of the brain working.
Okay. Now, let's delve deeper into what many consider the most critical aspect of due diligence: assessing the management team. Chapter 17 focuses specifically on management team due diligence, assessing the jockey.
Right. Evaluating the management team, especially the CEO, is widely considered paramount. Many VCs will say it's the single most important factor in their investment decision, particularly at the early stages. The chapter emphasizes that the team's ability to execute their capacity to actually translate their vision and plan into reality, navigating obstacles along the way, is the top criterion.
What exactly does execution capability mean in the context of a startup management team? How do you assess that?
Well, in this context, execution is defined pretty clearly as the ability to define and meet value creation milestones using optimum resources. Can they set goals and hit them efficiently? The book references Jeff Smart's extensive research from his book, Who? The A Method for Hiring. His work strongly emphasizes the overwhelming importance of having the right management team in place, getting the who right. Smart found that despite everyone saying management is critical, many VCs actually lack a clear, structured methodology for rigorously assessing people. They often rely more on gut feel, intuition, pattern recognition, rather than systematic evaluation.
The chapter draws this interesting contrast between lambs and cheetahs when it comes to execution styles. What does that distinction represent?
Yeah, lambs are used metaphorically to describe management teams, characterized by slow, maybe bureaucratic, often inefficient execution. They struggle to meet deadlines, they miss key milestones. On the other hand, cheetahs represent those teams that demonstrate rapid, agile, effective execution. They consistently hit their targets, they adapt quickly to challenges and changing market conditions. The historical example of William Shockley and the traitorous 8 who left his company to found Fairchild Semiconductor illustrates this point vividly. Shockley was brilliant technically, but apparently difficult to work with and slow to execute. The 8 were cheetahs. They needed to move faster. Peter Drucker's insightful quote about effective executives consistently getting the right things done at the right time also underscores his focus on effective action.
It sounds like thoroughly assessing a CEO and their leadership team is a very deep dive in itself. The book mentions it can take 200, 300 hours of dedicated effort. That's huge.
It can be incredibly time-intensive, yes. Yeah. Especially for a lead investor making a significant commitment.
What specific methodologies or frameworks do VCs employ for this in-depth evaluation of people?
The chapter introduces Jeffrey H. Smart's framework again from his work Art and Science of Human Capital Valuation. He outlines 4 distinct CEO assessment styles commonly observed among VCs. The art critic relies on intuition and gut feel. The airline captain focuses on clear objectives, metrics, checklists. The prosecutor interrogates, looks for holes. And the sponge absorbs vast amounts of data and perspectives. Figure 17.1 illustrates these. Each style represents a different primary approach to evaluating management. And interestingly, Smart's research suggests that certain assessment styles, particularly the airline captain style with its focus on objective results, correlate more strongly with achieving higher investment returns, IRR. The use of work samples in interviews is also discussed as a valuable technique, giving candidates real problems to solve to directly assess how they think, approach problems, and actually work in a practical setting, not just how they answer interview questions.
What are some of the fundamental questions, the core things VCs are trying to answer when evaluating a CEO and the broader management team?
The chapter highlights several key areas of inquiry, often framed as questions. Integrity. Are they fundamentally trustworthy, ethical, transparent? Can you rely on what they say? Intelligence. Are they sharp, adaptable, quick learners? Can they grasp complex issues? Maturity. Do they possess the necessary emotional intelligence, self-awareness, resilience, and leadership skills to navigate the inevitable ups and downs? And results. Have they consistently achieved meaningful outcomes against clearly defined objectives in their previous roles? Do they have a track record of getting things done? Don Valentine's famous quote emphasizing the critical importance of the jockey, the CEO over the horse, the market or tech, is also highlighted here. The background of Elon Musk is provided as a compelling, if extreme, example of an ambitious, driven, result-oriented entrepreneur. And finally, the chapter underscores the critical importance of conducting thorough background investigations, verifying credentials, checking references, looking for any red flags. It notes that a surprisingly high percentage, maybe around 50% of job candidates, misrepresent their qualifications to some extent. Background checks help mitigate that risk. They can also sometimes reveal personal issues that might impact job performance.
It sounds like VCs are trying to not only assess the current capabilities of the management team, but also, crucially, predict their ability to scale, adapt, lead, and perform under pressure as the company grows through immense challenges. It's a forecast as much as an assessment.
Exactly. Can this team take it all the way? That's the core question.
Okay. Now, let's shift our focus beyond just the management team to Chapter 18, Diligence beyond management. Assessing the market. Because even a great team needs a good market, right?
You're absolutely right. An exceptional management team with a groundbreaking product can still face huge challenges and potentially fail if the market just isn't ready or isn't big enough, or if the competitive landscape is too brutal. The chapter emphasizes that understanding the current state of the market, its potential for future growth, and the existing competitive dynamics are all crucial factors in determining the ultimate success of an investment. Roelof Botha's insightful quote about the importance of constantly tuning into evolving market trends really sets the stage for this discussion. You need to understand the waves.
The chapter introduces Ironstone, an investment firm that uses big data and analytics to assess early-stage opportunities. Their findings are quite striking. They suggest the founding team's attributes account for only about 12% of a startup's predictive success value, while the broader market dynamics account for a whopping 80%. That puts a huge emphasis on the market assessment.
It really does. Ironstone's data-driven approach suggests that while having a strong team is obviously important, the characteristics and the evolution of the target market have a far more substantial influence on a startup's likelihood of success, at least statistically. Their analysis indicates that startups are highly likely to pivot, to change their initial direction multiple times. And therefore, understanding the underlying market forces, the shifts, the potential future directions of the marketplace is paramount for investment success. Maybe more so than just betting on the team's initial vision. They advocate for a deep focus on the contours of the market itself, rather than relying solely on an assessment of the founding team's genius or intuition.
So what are some of the key questions VCs ask themselves when they're rigorously assessing the potential of a target market? What defines a good market?
They typically consider several critical factors. What's the current stage of the market's development? Is it a brand new emerging market? Is it mature and stable? Or is it highly fragmented with lots of small players? What's the overall potential for future growth and expansion? How big can this market realistically get? Is it a billion-dollar opportunity or a niche play? Does the company have, or can it build, a sustainable competitive advantage? What makes them unique and defensible? Is it technology, network effects, brand, cost structure? And what are the barriers to entry? How easy is it for new competitors to come in and steal market share? Warren Buffett's famous analogy about being a horse when a tractor comes along powerfully illustrates the importance of understanding potential disruptive forces and moats.
The chapter also touches upon the lean startup methodology, the importance of conducting quick, inexpensive experiments in the market to gather real-world feedback early on.
Yes, exactly. Clayton Christensen's quote emphasizes the critical need to actively create information about the market through rapid iteration and flexible experimentation. Rather than relying solely on extensive, time-consuming, and potentially flawed upfront market research reports, get out of the building. The chapter also introduces Sarasvathi's theory of effectuation. This describes how many successful entrepreneurs don't start with a fixed goal and then find the means. Instead, they often begin with their existing means, their personal traits, expertise, networks, and use those to explore various possibilities, with their initial plans evolving based on the new information and partnerships they gather from early market interactions. It's more adaptive. And finally, the chapter shares perspectives from Mark Andreessen and Todd Degris from Spark Capital on investing in Twitter early. They talk about their willingness sometimes to invest in companies that might not have a fully defined initial business model, but are demonstrating incredibly strong early user engagement or growth. It highlights that sometimes significant market demand and traction can precede a clear, obvious path to monetization. You bet on the engagement first.
It sounds like assessing the market is really about understanding not just its current size and competitive dynamics, but also having a strong conviction about its future potential, its trajectory, and whether this specific company has a real shot at capturing a meaningful piece of it.
Precisely. It's about understanding the wave and whether this company can ride it.
Okay. So, the team looks good, the market looks promising.
Okay.
Now we get to the actual deal itself. Let's move to Chapter 19, Structuring Investment Transactions. This is where the terms of the deal are actually hammered out, the term sheet.
Right. Once a VC firm has made the decision, yes, we want to invest, the next crucial step is negotiating and structuring the investment transaction. Getting the terms right. This is typically documented first in a term sheet, which, as Mark Suster aptly notes, might not be the most captivating reading for entrepreneurs, but it's absolutely critical. It lays the foundation, the blueprint, for the entire legal investment agreement that follows. Getting the term sheet right is vital.
Table 19.1 provides a list of the key components typically included in a term sheet. What are some of the most important terms that get actively negotiated between the investors and the company founders?
Oh, several key components are almost always subject to significant negotiation. The pre-money valuation of the company, what's it worth before the investment, and the total amount of capital being raised in this round. These determine ownership percentages, the type of security being issued to the investors. As we said, in venture capital, this is almost always preferred stock, not common stock like founders usually have. Liquidation preferences. These determine who gets paid back first and how much when the company is sold or liquidated. Hugely important. Anti-dilution provisions. These protect investors if the company has to raise money at a lower valuation later on, a down round. Any dividend rights associated with the preferred stock, though cash dividends are rare in early-stage VC. Board representation. How many board seats do the new investors get? Protective provisions. These give investors veto rights over certain key company decisions, like selling the company or taking on debt. Registration rights, which govern the process for a future IPO, and various other miscellaneous terms like information rights, pro rata rights, the right to invest in future rounds. A long list.
The chapter mentions different investment structures like debt or convertible loans, but indicates preferred stock is king in VC. Why is that the standard? What makes it preferable?
Preferred stock is the most common vehicle in VC, primarily because it offers investors this unique combination of potential upside participation and crucial downside protection. It allows them to share in the company's growth if it's successful. It converts into common stock, usually 1-for-1. But it also provides certain control rights, like board seats and protective provisions, and financial preferences over the common shareholders, founders, employees. Those preferences, especially liquidation preferences and anti-dilution, offer a degree of protection against potential downside risks if things don't go as planned. It gives them seniority.
Valuation is always a huge point of discussion, often contentious. How do VCs actually determine the pre-money valuation of an early-stage startup? It seems so subjective.
For early-stage companies, especially pre-revenue ones, valuation is definitely more of an art than a precise science. There's no simple formula. The chapter mentions various approaches VCs might use. Back-of-the-envelope calculations based on potential exit size, net present value, NPV analyses of future cash flows, though hard with early startups, comparisons to similar recent transactions, comps in the market, but it really emphasizes the inherently subjective nature of it. Aswak Damodaran, the famous valuation expert, is quoted saying that valuing young private companies poses some of the most difficult estimation challenges in finance. Michael Moritz of Sequoia Capital highlights their firm's focus on identifying and investing in truly best-in-class companies, sometimes implying that getting too hung up on precise valuation at the very early stages can be less important than just getting into a potential market leader. Price is what you pay. Value is what you get. Protracted, painful negotiations over valuation can sometimes lead to compromise solutions, like blended approaches or using financial instruments like springing warrants, as a way to bridge the gap between the investors and the founders' expectations.
Let's delve a bit deeper into some of those protective terms. Liquidation preferences seem particularly important for safeguarding the investor's capital if things go sideways. How do they work?
Liquidation preferences dictate the order of payout from a liquidation event, typically a sale or merger of the company, but sometimes a wind down. Preferred stock almost always carries a liquidation preference. It means the preferred stockholders have the right to receive a certain amount of money back before any of the remaining proceeds are distributed to the common shareholders. Usually it's at least their initial investment back, a 1x preference. Sometimes it can be higher, 1.5x, 2x, though that's less common now. These preferences can be structured in different ways. Non-participating preferred means they get their preference amount, say 1x their investment, or they can choose to convert to common stock and share pro rata if that would give them a better return. They pick the better option. Participating preferred means they get their preference amount back first, and then they also share pro rata in the remaining proceeds alongside the common stock, as if they had converted. This is often called double dipping, and is much less founder-friendly, less common today, except maybe in tougher deals. Participation might also be capped at a certain multiple.
Okay, that makes sense. And anti-dilution provisions, those are specifically designed to protect investors from the impact of future down rounds, right? When the company raises money later at a lower valuation.
Exactly. If the company subsequently raises a new round of funding at a lower valuation per share than the current investors initially paid, anti-dilution provisions kick in. They adjust the conversion price of the earlier investors' preferred stock downward, effectively giving them more shares of common stock upon conversion. This compensates them for the dilution caused by the down round and helps them maintain a certain level of percentage ownership. There are different types, different formulas. Full ratchet provides the strongest protection. It resets the earlier investor's conversion price all the way down to the new lower price, regardless of the size of the down round. Very harsh on founders. More common is weighted average anti-dilution. This adjusts the conversion price based on a formula that considers both the amount of new money raised in the down round and the extent of the valuation decrease. There are broad-based and narrow-based versions of the weighted average calculation, affecting how stock options are treated in the formula. Table 19.08 illustrates the mechanics. Other terms like dividend rights, usually non-cash, accruing dividends in early stage, board representation, how many seats, who controls the board, and protective provisions, what requires investor consent, are also crucial negotiation points to balance control and risk between founders and investors.
The chapter also touches on using things like springing warrants and pay-to-play provisions and structuring these deals. What are those?
Springing warrants are essentially options, warrants, granted to investors, but they only become active or exercisable if the company achieves certain pre-agreed performance milestones, often related to hitting revenue targets or achieving a certain valuation in a future financing round. They can be a useful tool to bridge valuation gaps. Founders get the valuation they want now, but investors get more equity later if the company underperforms. Pay-to-play provisions are designed to incentivize existing investors to continue participating in future financing rounds, especially if the company is struggling and needs more cash, an inside round or down round. Investors who do not play by investing their pro rata share in the new, perhaps difficult round might lose some or all of their preferential rights, like liquidation preference or anti-dilution, on their original investment. It forces their hand to support the company or face consequences. The chapter also mentions Peter Thiel's innovative use of a convertible note structure in Facebook's very early financing debt that converts to equity later, often used to defer tricky valuation discussions early on. And the benefits of structuring financings in stages or tranches with certain milestones needing to be met to unlock subsequent chunks of capital are also discussed. Keeps everyone focused. The chapter concludes with an example of a standard Series seed term sheet, Table 19.11, and emphasizes Rick Heitzman's point that simpler, more streamlined term sheets are often better at the very early stage. Don't overcomplicate things too early.
Wow. This chapter really highlights the delicate, sometimes tense balancing act in structuring deals, aligning the interests of investors and founders, providing downside protection for investors, while still incentivizing everyone to aim for a big upside outcome. So complex.
It absolutely is. The term sheet sets the tone for the entire relationship.
Okay, so the investment is made, the deal is structured. Now, the VC often takes on another critical role, serving on the company's board of directors. Let's move to Chapter 20, serving on the board.
Right. Once the investment closes, the VC's involvement is really just beginning in many ways. Serving effectively on the board of directors of a portfolio company is a crucial, ongoing responsibility. It's not passive. Donald Valentine's insightful, maybe slightly grumpy quote about the irritation of co-investors who constantly interrupt and talk over the management team really underscores the importance of the VC board member's role. Provide constructive guidance and support. Don't hinder the company's progress by micromanaging or grandstanding.
What are some of the key responsibilities and contributions expected of a VC board member? What's their job description on the board?
The board's primary function, fundamentally, is to provide strategic advice and oversight to the company's management team on the overall direction and health of the business. Fiduciary duty. This typically includes actively assisting in attracting and recruiting top-tier talent, especially senior executives. That's often a huge value add from VCs, providing mentorship and coaching to the CEO and the management team. Being a sounding board. Offering their strategic insights and pattern recognition based on their broader experience across many companies and industries, and overseeing critical governance matters, ethical standards, compliance, major financial decisions. Brad Feld succinctly summarizes the board's most important roles as focusing on capital allocation, making sure money is spent wisely, and providing unwavering support to the CEO, helping the CEO succeed.
The chapter mentions this paradox of success, where founder CEOs might gradually lose control of their company as they raise more and more rounds of venture capital and dilute their ownership. How do VCs on the board navigate that sensitive dynamic, especially if the founder isn't scaling?
That's a really common and often difficult situation. As a company scales and becomes more complex, the specific skills and experience required of the CEO often evolve dramatically. And sometimes, the original founder CEO, who was brilliant at starting the company, might not be the ideal person to lead it through its later stages of growth, managing hundreds of people, complex operations, maybe going public. VCs on the board have a responsibility a fiduciary duty to proactively and objectively evaluate the strengths and weaknesses of the current CEO, and crucially, to be prepared to have those difficult, often painful conversations about potential changes in leadership if it becomes necessary for the long-term health and success of the company and its shareholders. Promo Hicks, quote, emphasizes the potential for huge mistakes if boards wait too long, if they don't take timely action on non-performing or non-scaling CEOs. It's tough, but necessary sometimes. It's also vital for board members to avoid just passively accepting the management team's optimistic spin. Happy years. They need to maintain an independent, critical perspective, dig into the details, ask the hard questions.
What key qualities make for a truly effective venture capital board member? What separates the good ones from the bad ones?
Effective VC board members typically possess a strong blend of skills. Excellent interpersonal and communication skills they need to build trust and rapport. A keen ability to recognize patterns, seeing challenges or opportunities coming based on their experience. Significant experience in partnering with and supporting entrepreneurial teams, knowing when to push, when to support, when to get out of the way. A valuable network of industry contacts they can leverage for the company's benefit, recruiting, customers, partners, and a genuine capacity for mentorship and constructive feedback. Holding regular board retreats, offsites, can also be a valuable tool for stepping back and addressing critical strategic issues in a more focused, less formal setting than the regular board meeting. The chapter also highlights findings from an NVCA survey indicating that CEOs generally prefer board members who are perceived as entrepreneur-friendly and collaborative. They value constructive challenge, but they're wary of those who are overly hands-on, try to micromanage, or are purely confrontational.
So it's really about providing that strategic oversight, asking tough questions, leveraging networks, and offering valuable support, but without overstepping into the day-to-day management, a fine line. The chapter also touches on how VCs can add value specifically by leveraging their networks to facilitate sales and vendor relationships for their portfolio companies.
Yes, absolutely. A well-connected VC can often open doors for their portfolio companies, making introductions to potential key customers, strategic partners, or even crucial vendors. This can significantly accelerate a startup's time to market and overall growth trajectory. However, as Ravi Mohan points out, it's important for VCs to focus their efforts on these high-level strategic introductions and initiatives, rather than getting bogged down in low-level tactical sales details. They should enable, not do the selling themselves. Board discussions also frequently revolve around cash flow management, burn rate, and potential disagreements can arise on spending priorities, or, later, on the distribution of cash in an exit scenario. Aligning everyone on financial strategy is key. The example of Neon is used to illustrate the challenges that can arise when the initial market thesis just doesn't pan out as expected. It necessitates a difficult pivot in strategy, which the board needs to oversee. And the cautionary tale of the Intellium fraud case highlights the critical importance of board oversight and the potential for significant disaster when management actively misrepresents the company's financial situation. Vigilance is required. Finally, the chapter addresses the common occurrence of founder transitions over multiple funding rounds. It's often expected that leadership might change. It underscores the importance for boards to anticipate potential leadership gaps or issues early on and establish clear performance expectations for the CEO from the beginning. John Doerr is mentioned as being a highly effective, glorious recruiter of talent for his companies, and the growing trend of top VC firms bringing in experienced recruiting professionals as partners is also noted, highlighting how critical talent acquisition is. Sometimes the founder stays, sometimes they bring in a professional CEO, like Cisco did.
Serving on the board clearly involves a very active, very crucial, and often very challenging role for VCs. It requires a sophisticated blend of strategic thinking, interpersonal finesse, industry knowledge, and sometimes the courage to make really difficult decisions for the long-term health of the company.
Absolutely. It's where a lot of the value gets added or destroyed post-investment.
Okay. Now let's jump ahead to Chapter 24, which discusses the ultimate goal for most venture capital investments. Exit strategies. Getting the money back, hopefully with a profit.
Yes, exits. This is the end game. Exits are the essential mechanisms through which venture capital investors and their LPs actually realize returns on the capital they've invested over many years. Without successful exits, the entire venture capital economic model simply doesn't function. It all relies on eventually selling the investments for more than you paid.
What are the most common exit paths for venture-backed companies that allow investors to get that return?
The chapter outlines several common paths. The initial public offering, or IPO, where the company sells shares to the public and gets listed on a stock exchange, like the NASDAQ or NYSE. Historically, the biggest potential upside. A trade sale, which means the acquisition of the startup by another, usually larger strategic company, like Google buying a smaller tech firm. This is actually the most common exit route by volume. Secondary sales, where existing investors, like VCs or early employees, sell their private shares to other investors, like later-stage VCs or private equity firms, before an IPO or acquisition, provides earlier liquidity, redemption of shares by the company itself, where the company buys back the investor's shares. This is less common for successful venture-backed startups. And unfortunately, the write-off or shutdown, which occurs when the company fails and the investment is deemed worthless. That's the downside outcome. Table Code 4.1 indicates that, historically at least, IPOs have tended to yield the highest average returns for venture investors, although they're rarer than acquisitions. Jeffrey Timmons' somewhat cynical observation that lemons ripen faster than pearls, also illustrated in Figure 24.1, is a good reminder that failures often become apparent much more quickly than the big successes, which can take many years to mature.
What are the key factors that influence the timing and the eventual valuation of an exit? When does a company decide to sell or go public?
Several key factors come into play and influence that decision. The overall health and conditions of the broader financial markets are huge. Is the IPO window open? Are acquirers actively buying? Market sentiment matters a lot. The specific company's own performance and its growth trajectory. Is it ready for the scrutiny of the public markets? Does it have the scale to attract buyers? The personal motivations and objectives of the company's founders and management team. Are they ready for the next chapter? Do they want liquidity? And the collective interests of the company's shareholders, particularly the common shareholders. Ultimately, the company's board of directors typically plays the most significant role in evaluating options and making the final decision about the timing and nature of an exit. It's a board-level decision.
Trade sales, acquisitions, seem to be a more frequent exit path than IPOs for many venture-backed companies. What's generally involved in that process from the selling company's perspective?
The buy-side acquisition process usually starts when a larger company identifies a potential target that has something desirable. A key technology, a strong team, access to a new market, a valuable customer base. While the larger company might consider building these capabilities internally, build versus buy, acquiring a startup can often provide a faster and more efficient route to market or access to specific expertise or talent. Warren Buffett's well-known wisdom on CEOs and acquisitions cautions against deals driven by corporate ego or empire building rather than sound strategic rationale and financial sense. Buyers need discipline, too. Investment bankers often play a crucial role in facilitating a trade sale for the startup. They help identify potential acquirers, market the company, generate competitive interest. An auction process is ideal to maximize price and negotiate the final acquisition price and terms. The successful acquisition of Link Exchange, a company Sequoia Capital had invested in, by Microsoft back in the dot-com era, is given as a prime example of successful trade sale outcome for venture investors, a big win for them.
And what about the process of taking a company public through an IPO? That seems like a much more complex, demanding, and expensive undertaking.
It certainly is. Going public is a massive transformation for a company. Ernst & Young's guide, mentioned in the text, outlines 3 main stages. The initial planning phase, getting your house in order financially and operationally, building the management team. The intensive due diligence process with lawyers and accountants, preparing the registration statement, the S-1. And the final execution of the offering, the roadshow marketing the deal to institutional investors, pricing the shares, and the first day of trading. This includes developing a compelling long-term business plan and narrative that will resonate with public market investors, thoroughly benchmarking the company's performance against public comps, and carefully selecting the investment banking underwriters who will lead the whole process. The traditional IPO process often results in that initial pop in the stock price on the first day of trading. Some see this as evidence of the underwriters intentionally underpricing the offering to reward their institutional clients. The Dutch auction method, famously used by Google for its IPO, represents an alternative approach designed to more efficiently determine the market clearing price and potentially reduce that first-day pop, giving more proceeds to the company.
The chapter also mentions secondary markets like Shares Post and Second Market, now part of NASDAQ Private Market. How do these platforms provide liquidity for investors and employees in private companies before a big exit?
Secondary markets provide a valuable mechanism for private shareholders, including early employees with stock options, founders, and even some venture capital funds, to sell their shares in privately held companies before a formal exit event, like an IPO or acquisition. These online platforms facilitate transactions between willing buyers and sellers, sometimes through auction-style bidding, sometimes through more informal bulletin board systems where bids and asks are posted. They offer a degree of much-needed liquidity in an asset class private company stock that is typically characterized by very long holding periods and extremely limited tradability. It allows people to get some cash out earlier. Excel Partners' secondary sale of a portion of their large stake in Facebook before its IPO is cited as a notable example of a significant VC transaction occurring on these secondary markets. They took some money off the table early.
So really understanding these various potential exit strategies, IPO, acquisition, secondary sale, it's absolutely crucial, both for VCs when they're making the initial investment decision, how will we get out, and for their LPs when they're evaluating the overall attractiveness and potential returns of investing in a venture fund.
Absolutely. The potential for and the realistic pathways to successful exits are what ultimately drive the entire venture capital investment cycle and determine whether everyone makes money or not. It's all geared towards the exit.
Well, this has been an incredibly insightful, really comprehensive deep dive into the intricate world of venture capital. We've certainly covered a tremendous amount of ground today. From understanding the motivations and characteristics of individuals pursuing a VC career, to the complexities of fundraising from all those different types of limited partners, the critical elements of defining an investment strategy and conducting rigorous due diligence, the ongoing crucial responsibilities of serving on a company's board. And finally, the various pathways to achieving those all-important successful exits.
Indeed. It's a truly complex, multifaceted industry. It demands this unique combination of sharp analytical skills, strategic foresight, deep industry knowledge, and, frankly, really well-developed interpersonal abilities to navigate all the relationships involved. And a thorough understanding of the underlying motivations and operational processes of both the venture capital funds themselves and their limited partners is absolutely essential for anyone seeking to truly understand or operate within this fascinating and hugely influential landscape.
So as we bring this deep dive to a close, here's maybe a final thought for you, the listener, to consider. Given the inherently high failure rate of early-stage companies that we've discussed, and the often very long time horizons required for venture capital investments to mature and potentially generate those outsized returns, what truly distinguishes a genuinely far-sighted, potentially transformative investment from what might ultimately prove to be, well, simply a high-stakes gamble? Where is that line?
It's definitely a challenging question worth pondering as you continue to explore the many nuances of the venture capital world we've discussed today.